Call to order for the BOI regular agenda at 9 a.m. Wednesday, November 12th, 2025. Mr. Jones, would you lead us in the Pledge of Allegiance, please?
Here we are. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you, Mr. Jones. Any procedural teleconference under 2449?
No.
Excellent. Approval of the minutes. We can't vote on that. We're gonna
I just have to do attendance.
Oh, sorry. Can you call the roll, please?
Ms. Ginsburg?
Yes.
Ms. Mee?
Yes.
Mr. Green?
Present.
Mr. Rue?
Present.
Thank you. Mr. Gatto?
I'm here.
Ms. Martinez? Mr. Jones?
Present.
Ms. Langton? Staff participating in the meeting includes the following: CIO John Grable, Deputy CIO Jude Perez, Chief Counsel Stephen Rice, Deputy Acting CEO Louis Ligo, AEO JJ Popovich, CFO Ted Granger. Staff participating include Jessica Rivas, Esmeralda Del Bos, Christopher Wagner, Scott Drazel, John Kim, Catherine Tan, Jesse Gonzalez, Didi Acevedo, and Derek Kong. We also have several consultants on site: Makita Group, Stepstone, and Alborn. Trustees, please use your raise your hand option to be placed in the queue. At this time, we ask all meeting participants to mute your mic until you're ready to speak, and now we will proceed with the agenda.
Okay, thank you, Linda. Thanks for keeping me on track too. We're gonna forego the approval of minutes until we have quorum. Item 5, public comment.
We do have public comment. The first person speaking today is going to be Mohammed Abdali. Mohammed, you will have 3 minutes to address the board, and you may approach the podium.
Good morning, everyone. My name is Mohammed Abdullah, and I work at a portal for Sky Shifty.
Mr. Can you just move closer to the mic so we can hear you?
Yeah, my name is Mohammed Abdullah, and I work as a portal for Sky Shift as Phoenix Sky Harbor Airport for about 1 year. I'm proof a member for unit local 11. I love my job. I love my job, and I help in wash dishes and chickens and make sure everything run smoothly, so passengers get the mails on time. It wasn't just a job to me. It gave me the ability, and it gave me the opportunity to support myself. When Sky Cafe took over the American airline contract, I applied right away for my old job online, but I never heard back, and I never received an interview. So I did my brother who wanted for a walk-in interview, but neither of us heard back after. I also applied at Aramark Sky Cafe, but still not luck. Now I am out of work, and I'm so worried about how to pay my rent and support myself. Meanwhile, Sky Cafe held dozens for people without prior experience working at the airport to fill position like mine. I come to this country from Somalia, so I called the work hard and build a life for myself. I did everything right, but now I feel like it is slipping away because Sky Cafe failed to help many of the people to already now how to do the work. I'm left with nothing, and it is my understanding that the poor transition has led to problem in surfing flights. Atlantic Street Capital and its company Sky Cafe and causes these issues. I feel like Atlantic Street is treating me like a number, not human being, but situation is bad for the workers and it is bad for visitors. Uh, Atlantic Street is disrupting essential workers and not performing the way it will be for visitors. Please tell them to do the right thing, investing in workers like instead of casting aside can only help the Atlantic Street driver the returns you serve. Thank you.
Thank you. Thank you.
Thank you.
Go ahead. The next speaker is gonna be Abshiri Sakta.
Good morning. My name is Abshir Saudal, and I work as Unity for Sky Shift at Phoenix Sky Airport. 7 months. I am member of Unit here, local 11. When Sky Cafe talk offer the American Airlines contract, I apply right away to get my job back. I never hear anything. I also apply with Air Market Sky Cafe subcontractor, but I still have not been hearing. Now I am driving for Uber to try to make ends meet in help lit, but it's not consistent or sustainable every week. Sir, I am not always here. I will be obliged to earn each to cover my bill. Meanwhile, Sky Cafe has hiring people we have never worked at airport will background check and train employees like me. When I have how I will pay my bills this month. I like my brother to come this country, Somalia, to work hard, building better life. I have done everything I cannot, but now I feeling like all that hard work is being taken away from me, all because Sky Cafe feeling to her experience workers like me. Please tell Atlantic Street to do right thing and bring back experience work like me. Thank you.
Thank you.
Next speaker is gonna be Alex Rosado.
Good morning, members of the board. My name is Alex Rosado. I'm an organizer with Not Here Local 11, representing SkyChef workers at Phoenix Sky Harbor Airport. I want to start by thanking this board and LACERA staff for engaging with us and for reaching out to Atlantic Street Capital about what's happening at Sky Cafe, one of its portfolio companies. Your willingness to listen and take this seriously means a lot to our members. Despite those efforts, the situation has only gotten more unstable. When Sky Cafe took over the American Airlines catering contract from Sky Chefs last week, nearly 200 trained and security cleared workers were laid off, even though the work itself stayed exactly the same. Sky Cafe could have simply hired the existing workforce and ensured a smooth transition, but they didn't and declined to speak to workers workers' representatives when we first reached out. Indeed, the process has been chaotic and confusing. Based on information collected by the union, about 19 former Sky Chefs employees were hired by both Sky Cafe and Aramark, and most of which we believe ultimately opted for Aramark. Others were left out entirely, even after applying multiple times. Workers like Mohammed Adil, who spent a year doing this exact job, have been left jobless and anxious about how to make ends meet. Meanwhile, around 13 Sky Chef drivers were allegedly offered jobs at Sky Cafe despite not being laid off. These challenges have led to alleged problems servicing flights. After the contractor transition last week, American Airlines still requested for Sky Chefs to continue servicing carts that Sky Cafe was supposed to cover, but allegedly couldn't due to operational challenges. Meanwhile, Sky Chefs had to hire many temps earlier this month to cover employees leaving for Sky Cafe. All of this could have been avoided if Sky Cafe had respected the existing workforce from the start. The labor dispute facing GAT, Sky Cafe as Phoenix Car Harbor Airport is only one of the issues that should concern LACERA as a limited partner in Atlantic Street Funds 3, 4, and 5. According to LACERA's Q2 2025 Private Manager Scorecard, Atlantic Street Capital performed poorly, scoring a 2 out of 5 on ESG, with 5 the best, a 1 of 5 on performance, S on organization operations, and A on partnership, and 3 of 5 on fees and terms. Notably, Atlantic Street's ESG score was downgraded to 2 out of 5 from the prior quarter, indicating that even prior to any labor disputes at Phoenix Car Harbor, investment staff identified concerns with the extent to which material ESG factors are identified, assessed, and incorporated into risk, return analysis, and portfolio construction. We know LACERA has raised concerns with Atlantic Street, and we truly appreciate that. Unfortunately, this has not translated into a resolution of this dispute. We recommend LACERA reevaluate Atlantic Street's fitness as an investment manager, given its record of instability, layoffs, and poor performance. Thank you.
Thank you. And
Thank
the
you.
last speaker is going to be Jen Fong, and you will have 3 minutes to address the board.
Good morning. My name is Jen Fong, and I'm a researcher with Worker Power. As you have heard, it appears that LACERA's investment in Atlantic Street Capital Fund 4 was negatively impacted when the debt-laden acquisition Zips Car Wash went through bankruptcy this year. Under ASC's ownership, Zips acquired 95 additional locations, nearly doubled its annual revenue from $184 million to $345 million, and assumed $655 million in debt and $300 million in preferred equity before filing for Chapter 11 bankruptcy in February 2025. In bankruptcy filings, Zips stated that substantial funded debt obligations and maturities, macroeconomic headwinds, competitive pressures, and burdensome lease obligations constrained Zips' financial condition and ability to grow. Zips further reported that recognizing these headwinds, it negotiated savings with its vendor partners and optimized on-site labor and consumable spend. According to Aquashine Express Car Wash Chief Operating Officer Keith Lawrence, Zips' mission was to grow as fast as possible. Lawrence stated that Zips cut labor costs by firing all the directors and all the ops team. According to Lawrence, site managers were often working alone or with 1, 2, or 3 employees max on the schedule. We've had a lot of their people come to us and ask for jobs. ASC Fund's equity stakes appear to have been wiped out when Zips emerged from bankruptcy on May 1st, 2025, under the new ownership of its lenders. ASC Fund 5 also faces significant issues. According to LACERA's AB 2833 report for the fiscal year ending June 30th, 2025, Fund 5 had called only $7,483,888 of committed capital, or 5% of LACERA's commitment, while peer funds from the same vintage year of 2022 had called 54% of committed capital. As of Q2 2025, Fund 5 had an IRR of negative 48.18% versus positive 18.92% for PitchBook's benchmark of 16 peer funds, underperforming by over 67 percentage points. Fund 5 also had dry powder of $337 million, or 81% of the $415 million raised. ASC is a case study of a private equity firm that has failed to deliver returns as should be expected and failed to adequately address pressing human capital risks. Why has ASC failed to deploy capital from ASC Fund 5? And what else explains the fund's negative 48.18% IRR? How much did ASC's investors lose as a result of the ZIPS bankruptcy? And how much did ASC make in fees from the deal? How many workers were laid off as a result of the bankruptcy? And did they receive severance payments? What lessons should LACERA take from the ZIPS bankruptcy and Fund 5's precarious position? And how should the fund ensure other managers don't repeat ASC's mistakes? Thank you.
Thank you, everyone, for your comment, and just to appreciate it and encourage to continue to reach out to staff. Thank you. Moving on, executive update, item number 6.
Good morning, Mr. Chair and trustees. Can everyone hear me? Okay, great, thank you. It's good conversation this morning in the Equity Committee, and the comments that I'm about to go through, I think map nicely to some of that discussion. So hopefully we can pull some of those threads. And if we can begin on slide 5. Thank you. This slide shows the performance of major capital markets over various time periods ending on Halloween, October 31st, 2025. And given the Halloween date, certainly what this shows is a treat for the chart on the upper left, which shows our public equity benchmark, which is the MSCI ACWI All Country World Index. It's our global equity market index. And maybe I'll run quickly away from Halloween because I can't continue with that, is that this chart may disprove the proverb about trees growing to the sky. The ACWI IMI is up 21% annualized over the last 3 years. Fiscal year to date, so that's 4 months, it's up an astonishing 10%. That's so far in excess of our capital market assumptions. So some perspective on that. And I think I gave some perspective on the same topic last month, is this has an impact on our performance. It's both positive and positive. Our absolute performance is benefiting from the bull market in equities. And I'll go through some charts later on in the CIO report. I'll finish with one. Our relative performance may be less attractive relative being compared to some peers. We have a very diversified portfolio. We're much less reliant on public equity than most. So the contours and nuances of this public equity bull market is distorting our benchmarks. We've discussed that, and that ties to some of the discussion we had in the Equity Committee about private equity. Our private equity benchmark is public markets plus a premium. So it's to do that 21% annualized plus 200 over 3 years. That's impossible. That would be, in some sense, too much risk in that portfolio. It would be trying to maybe just do early stage venture and hope that you hit just the winners. Now, it's important to recognize that this distortion has a big impact in that private equity is our second largest strategy at 17% after public equity. So underperformance there impacts the total fund. The other thing about the contours and nuances of this equity bull market is that it's highly concentrated. And Dale did help me with some numbers that I'll go through right now. That public markets are highly concentrated right now. It's the highest level of concentration in over 30 years. You read the newspapers, you listen to the financial press, you watch TV, and there's a lot of talk about Magnificent Seven. The Magnificent Seven has significantly outperformed, and you can see that if you look at the row that says US large cap, that really is dominated by the Magnificent Seven large cap US stocks. And you'll see that going back 10 years, the dramatic outperformance there. I saw an interesting chart over the weekend, and maybe, if you pause there for a second, that really says a lot about the lack of a life I have, that I'm looking at charts about stocks over the weekend. But the Magnificent Seven outperformed the S&P 500. So that's the largest 500 companies in the US minus the Magnificent Seven. So think of the Mag 7 versus the 494 or 492, whatever the exact number is, over the last 5 years by 4x. So it's just like a really remarkable statement. Today, or as of the end of October, the Magnificent Seven account for 34% of the S&P 500. That's a huge number. If we go from the row that says US large cap to the upper left, our benchmark, the MSCI ACWI IMI. So that's the global index of about 8,400 companies. The Magnificent Seven represent 20% of the total value of that index. That is about double from where it was 5 years ago. So the markets are really narrowing. And once again, that has an impact on our benchmarking, because in some sense, our benchmark is becoming more and more, we're comparing all these different asset categories, all our equity portfolio, to a really narrow slice of our economy. To put in perspective the narrow slice, the Mag 7 represent about 5% of revenue of the index, still very concentrated, but not the 20% of value. They represent 10% of earnings. Once again, shows how powerful and profitable those companies are. But once again, the market cap is a multiple 2x of those earnings. Employment is an even lower number than that. The largest 6 stock markets outside of the US, so that's Japan, the UK, China, Canada, France, and Taiwan, are all smaller than the Mag 7. Not as economies, but just in terms of the market cap. So this concentration is even more narrow if you zoom out just a little bit to the 18 largest artificial intelligence related names in the ACWI IMI. And those 18 companies represent 26% of the total global market capitalization. So really narrow. And this may understate that this is impacting other asset categories. You think about credit. There's a lot of credit investments that have been made in those same companies. So this is, capital markets are very narrow. And so we're looking at broadly diversified and comparing it to very narrow. So obviously this is concerning. This wasn't on the weekend, but I read Howard Marks, the investor, the legendary investor from Oaktree, his most recent market memo. And in it, there was a phrase that stuck out for me, which is about markets often going to extremes, that they go overnight from flawless to hopeless. And I kind of, when I was reading that, I was thinking, oh, maybe that's Billy Joel that he took the inspiration from. But I think that markets do go to extremes. The problem is we don't know the direction of travel from any point in time. That tree can keep going to the sky, or it can fall down and sprout up lots of new seedlings. And so we don't know the direction, and we don't know the duration of this move or next. So what do we do given that uncertainty? And I always look to reorient myself. Maybe the LACERA North Star is our investment beliefs. And those investment beliefs highlight the fact that we are investing for multiple time horizons. We're not trying to time the market today to perfect it, because there are consequences if we're wrong. And the move away from diversification can be significant because we're a mature pension, we're cash flow negative, and that means that we always have to be diversified in every single market environment, because it is our best offense and our best defense at the same time. And we look to operationalize these beliefs. And the principal way to do that is by rebalancing. We have 2 discussions in closed session today about rebalancing. It's something I think that we do very well. And the other thing that we do is we revisit our strategic asset allocation. Once again, that's by policy, and we'll begin that exercise next year. So if we could turn to slide 8, please. So the pension fund was up 1.5% net through September, the end of our first fiscal quarter. AUM, assets under management, were 88 billion. Another high water mark, which is fantastic. Always like those high water marks. We could see in the bottom middle, cash equivalents were $1.2 billion. And on the right, our functional allocations are all on target. And, I say that every month, we're right on target with our functional asset allocation. And maybe this goes back to the statement about operationalizing rebalancing. It's not without a lot of effort that I make that statement every single month that we are right on our strategic asset allocation targets. And there's so much effort amongst the team behind me in the office there. I'm just the cheerleader for the team, is the capabilities we have in the asset categories and in middle and back office functionality that allows us to make that statement to implement in maybe the most pure way the board's strategic asset allocation targets. Next slide, please. So this slide shows the performance of the fund and the functional categories compared to benchmarks over time. I'll draw your attention to the row, pardon me, it says total fund. And if someone has a bottle of water, that would be great. The fiscal year to date, the fund is up 3.7%. We can see, thank you so much. Losing my voice. The total fund row, fiscal year to date, we're up 3.7% for the 3 months for the first quarter. We've underperformed our benchmark, which is 5.4%. So that is a rather significant underperformance. Private equity, we just had a committee meeting discussing it. Private equity accounts for 100% of that underperformance. And that underperformance principally relates to the discussion that I just had, or we just had rather, about the Magnificent Seven on slide 5. That it's a benchmark that's non-investable, that short term isn't working to reflect, the merits or dismerits of our private equity portfolio. And the question that the vice chair asked during the committee meeting, of Mr. Fernandez was, well, do we lean in or lean out? Do we revisit? Is the last 3 years representative of a new normal? Or are we going to go back to the old normal where private equity was our best performing asset category? I think it's something that we need to do next year during our strategic asset allocation exercise. And private equity is different. It is, I think that the statement was made that private equity is an $11 trillion industry. The Mag 7 are 20 trillion in and of themselves. So private equity is underperforming 7 stocks. And it's a discussion we have to have about allocations, about benchmarks, because I don't know if right now we can best understand the merits or dismerits of that exposure in our portfolio. And it's one that is really important for us, given the long-term performance. It's benefited our members by being our best returning strategy since the mid-'80s. But at the same time, we can't just focus on the past. It's our highest cost strategy. And we just need to focus on what our prospects, what we deem those prospects to be prospectively. Credit also is the next largest contributor to total fund underperformance for the first quarter of the year. we discussed in closed session. And this also gave rise to the discussion that Didier led about a systematic approach to IPOs. We had a really successful credit investment that converted into public equity. It is a highly concentrated position. It has introduced volatility into our credit portfolio. We are working very diligently to reduce that volatility. For me to criticize me is we need to work faster on that. Chad, Jude, and I were on a call yesterday, on it was Veterans Day. Thank you to all the veterans out there. In addition to thanking veterans, we were working towards better managing the volatility in this portion of the portfolio because it's important. The positive is on this slide, maybe the most positive is that we're above the 7% actuarial hurdle over the 10-year period. That is a really important statement. That is what pays benefits to our members. And that is maybe the most key number on this page. I know next year, or we're in the midst of our experience study. So in addition to thinking about PE in the context of our strategic asset allocation, that's the asset side. The experience study focuses a lot on the liability side. By focusing on the two things that are most important to this board, I think that we can best position the fund such that 10 years from now, when someone's in this seat on the first floor, we can, or that person can say in 10 years, the 10-year period looking back, we're smartly, significantly above the 10-year actuarial hurdle. Turn to slide 13, please. And this goes from the total fund to OPEB. OPEB was up 2.3 net for September. I'll wait till we turn back. Great, thank you. AUM for OPEB, maybe I'll switch the order. There's another high water mark of 5.4 billion. I love saying high water mark, and I can do the quick math and say 88 plus 5.4. We're nearing, I put that in the mid 90s in terms of total AUM. We can't quite round up to 100 billion yet, but hopefully soon. Next slide. And this once again shows the performance of the OPEB trust, the major functional asset categories compared to benchmarks over the month to the 10-year period. Fiscal year to date, OPEB is up 4.9%. That's near its benchmark. It's a fantastic number. There's a slight underperformance. Two reasons. The first, I bet everyone can guess, which is private equity. That the private equity program for OPEB is ramping up. We've discussed in the past the concept of a J curve, where investments, funds recognize fees and expenses before returns, and that program is in the midst of the J curve. So if you combine the harder environment for exits with the front loading of fees and expenses, that leads to underperformance within the slight underperformance compared to the benchmark. OPEB has a lot lower allocation to 5% target than the pension. OPEB's 5%, the pension 17%. Maybe the positive in terms of allocation of what's known as the allocation effect. We don't have to go back to the slide, but PE target allocation 17%, and our actual NAV or net asset value is 15.7, 15.8. So we're under our PE. So we're getting some slight benefit from that. Like the pension, OPEB is showing strong performance over the past 10 years. And I'll finish on slide 21. This slide shows the change in our net fiduciary position. I reflect back on the actuarial training that all trustees receive, which talks about C plus I equals B plus E, contributions plus investments equals benefits plus expenses. That's kind of what is captured on this slide. And I'll say this as acknowledgement or caution. The graphic on the bottom left, it's a small chart, but a powerful one. The graphic on the bottom left has information for the past 27 months. That's the total net position change in billions for all of fiscal year 24, 25, and fiscal year to date in fiscal year 26. We've been positive over that period 70% of the time. Sequence of returns matters from an actuarial standpoint for a plan that is cash flow negative. Being right 70% of the time is outstanding. And moreover, the amplitude of those, the positives makes that statement even more significant because there's a huge magnitude. The net change during those 27 periods is about $14 billion after paying member benefits and expenses. I mean, I think that everyone here, if we, good day, bad day, think about $14 billion after accomplishing our mission. So I feel good about that. And I know that we have good days, bad days, hard days, white knuckle days, you name it. And I think that that statement about $14 billion should ground us, but should also motivate us at the same time. So once again, they're huge gains. They're above expectations. And maybe the best aspect of it is we've generated those $14 billion while being very defensively positioned by having that lower equity allocation than most. So with that, Mr. Chair, I'm happy to take some questions.
Thank you, John. Just making some notes. Slide of the month. Any expansion on it? Did you not include one? This staff chart of the month. There we go. Any information on the increase big tech with this chart?
Mr. Chair, I think that this goes to the comments about the markets being driven by the Magnificent Seven, that many of these four are amongst the Mag 7 names, and that it's not just equity markets that are being impacted, but this $100 billion, some of it may be cash from those companies, but the cost of capital is so low for them that this is being funded by credit. And so our exposure, we may be overexposed in multiple asset categories to what are known as the hyperscalers. So I think that this is, obviously it's transforming capital markets in a more broad sense. It's transforming economies. It's transforming the labor force. I know that the workforce is being negatively impacted by potentially, or the net change may be AI replacing some jobs. Maybe it's creating different jobs and new jobs, but I think it's something that we just need to be mindful of, that this is it may be more than a moment in time.
And that's at 20% of the market with the AI influx to it that you're referring to. Yeah. And that's one of the things I just quickly, I attended the AI segment at Super Investor, Super Return. And I think, one of my takeaways was it's having an impact now. And they're saying some of the things where they saw a 20 to 40% increase in the bottom line revenue, production, whatnot. It's like, if not now, eventually, right? But it seemed to produce these values, this type of increase, but mostly in the automated type sectors. Things. It's the same kind of thing with the robot construction, textile, stuff like that. It had kind of a limited use right now to get that kind of production, which I found very interesting. They kept extolling how AI's changing increasing the bottom line, but it seemed to be only in one area. But eventually like you said, that human capital cost possibly. So it's fascinating stuff.
And I think, Mr. Chair, if I may, I think it's so important from, and once again, this is outside my lane as CIO, from a societal perspective, that we invest in subsequent generations, because if we don't hire people to enter the pipeline at the foundation, people aren't going to have the right experience to move up to middle management and senior management. You know, I'm not a musician, but you can't be a concert pianist if you don't know your scales. And we have to make sure that people learn their scales.
Yeah, absolutely. I mean, and you know, a lot of this stuff is, this AI still is you know, it still requires human input, intervention. It's not there, but I mean that it's growing exponentially with these, especially the processing systems of supercomputers. And I don't think we're going to be bombed by Skynet anytime soon, but you know, when it comes to some of this stuff, and then of course in the you know, having kind of that in the markets, utilizing the AI just for that brief, especially in a private market, that millisecond of advanced timing that you might get out of it through predictive, you know, algorithms or whatever. It's I don't know. It's interesting because the equilibrium, like, is it going to just equalize everything? You know, I mean, these are kind of the unknowns. And I agree with you. I think we have to think about the next step, have, you know, like, for the integrity of all of it, the succession moving forward without our, like you said, no crystal ball, but our best guess in a direction. And if we get it wrong, we step to the other pathway and try that out. But at least we're trying, right? Chance favors a prepared mind. Thank you, Mr. Grable. I really appreciate it. Go ahead.
Thank you,
Christine.
Chair. Appreciate a lot of things that covered today. Glad that you cover a lot of things in my mind too. And then appreciate the discussion about the AI. I think AI is unpreventable. You know, it's where we're going. It's innovation interruption to our society, right? So it's in a positive way, but it will come with the pain. But what I want to say to the workers out there that have job security concern is that I don't think AI is going to replace people. AI is going to replace people who don't use AI, who don't adapt. So survival to the fittest. So I hope that's leave a thought to people that have job security concern. You know, how do you prepare for that era coming? It is coming, unpreventable. So that's one thing. And the other thing is that I was about to ask when we're going to do the asset allocation review. Glad to hear that it's coming next year. You know, the reason I was concerned, want to know when we're going to do it, is because when we did the last asset allocation, there's a lot of things we didn't know, and no one can anticipate things that have happened in the past year. Right, the environments change, you know, geopolitics carry inside the US, a lot of things change, right? This is just 1 year. And next 3 years, what to expect, we don't know. So interest rate, we did the asset allocation position in the high interest rate environment. We might be heading to a low interest rate environment again. So I'm glad that we're going to do the asset allocation review in next year. So we revisit, you know, all the assumptions that were made, assess the current environments out there. So what I see is that, you know, like, is maybe the past 10 years, 20 years was a globalization, but what the environment changed now is deglobalization, right? So the geopolitics. So what I see is that business, in order to survive, you know, in order to survive the terrorist wall, they find places to go, they find new market, they create new ecosystem in different place, and then make their money, you know, expanding there. So business is going to find a way to survive, and that will create, you know, potentially, you know, opportunity in somewhere else that might not be the same as the past. So that's what going to lead me to the question I want to ask is that if we go to slide 5, when we do the assets review, I think we should, you know, think about it. Right? When we look at slide 5, what I want to point out is that I think a lot of business find their way somewhere else, find their way in other new market in this new global environment. So you can see the non-US all cap emerging market, they're outperforming, they're performing really, really good. And they're figuring out, business figuring out a way to make money. So I think there's opportunities that maybe we should assess, you know, considering, you know, the allocation in different market, different geographic region. So something to look into, I think. I know that right now we have 76.5% assets in the US and 23.5% in outside the US. So something to think about. Is there some opportunity out there we want to tap into? And this is also tied to the diversification to reduce risk, right? Uncertainty, we have a lot of uncertainty, we have a lot of risk. So maybe it's one way to look at diversification to reduce risk, global, diversification in our assets allocation. So just a thought, when we do that review next year. It's all the comment I have, but I want to say that about us hitting $100 billion, I'm very hopeful because since my 2 year here, I have seen the fund increase more than $10 billion, a short 2 years time. So I think we're gonna hit this on, and thanks to everyone, our CIO's leadership, the whole team's effort, and I hope to see happen soon. Positive, yeah. So that's what I have. Thank you. Thank you, Chair.
You bet. Also too, I want to point, I know the fiscal year to date numbers, like you said, they're underperforming from the benchmark, but we're not even halfway through the fiscal year. I mean, there's, and I have really good confidence in, through all the things you described that are asset that, and it's like you said, it's very interesting that it's one area that's creating this underperformance, and that will be addressed. The risk management process of staff and everything to handle this. And again, we've got a whole half a year to see what it lands on. And I love your point, John, about the 10-year and even the 5-year mark. That shows. Sometimes it's a sprint, but sometimes it's a half a marathon, and so that's telling. That shows a resilience to kind of these fluctuations. So and the plan's working. So thanks for highlighting that. Anybody else have any other comments from the virtual world? Mr. Gatto, David? Thing? Okay, seeing and hearing none. Mr. Popowich, we have one of our own that we're celebrating today. Please go ahead.
We do. Thank you very much, Chair, and good morning, trustees. The member spotlight is a way for LACERA to recognize the public servants that care for the constituents of Los Angeles County, and in this case, care for our members as well. It's also an opportunity for all of us to reflect on why we do what we do as we serve our members and empower them to have a healthy and secure retirement. And so this month, we're recognizing Bonnie Weiss, who is retired in this past September with 25 years with LACERA, all of it in disability retirement services. She started out as a word processor, worked herself up, and she was responsible for managing all of the documentation for the members' disability cases, making sure they're complete and ready to present it to the Board of Retirement so that they can make their decision on the disability application. And she is also a very proud member of our employee council team, where she served as president and vice president. It's a very important role in our organization and our culture in helping create a positive work environment. And so we thank Bonnie Weiss for everything that she's done. She's going to do some traveling, organize her house. Boy, I wish I had time to do that, and playing bingo. So we wish her all the best of luck, and hopefully she'll strike it rich. Thank you very much, Bonnie.
Yeah, it looks like she's does the bingo for real too, with her money. Thank you, Mr. Lugo. Please go with 6C, the Chief Executive Officer report.
Yes. Good morning, Chair Green. Good morning, trustees. Just a quick follow-up from the committee meeting this morning. Trustee Gatto, in terms of the videos and educational videos that we have posted for trustees and also members. We do have a YouTube channel, and all the videos are posted day of. So all the educational content, and it's also structured in a table of contents. So you don't have to shift through the actual video. You can go right to the agenda item. But we will look at categorizing some of the educational videos, cataloging those over the last 2 years to have a better information for the trustees to easily access. So, but if you haven't subscribed to our channel, here's a shout out to do so. We can pull up do we have the? Okay, great. As we're pulling up the CEO report, I'll just highlight a few items and then I'll take any questions thereafter. Election results. The Board of Supervisors finally ratified the safety elections. So I want to officially congratulate both Trustee Kehoe and Trustee Green on their elections into the upcoming term year, which is January 1st through December 2026 through December 31st of 2028. Trustee Kehoe will assume the BOR 7th member and BOI 4th member duties, and then Mr. Green or Trustee Green will assume the BOR alternative safety member duties. So again, want to congratulate both Trustee Green and Trustee Kehoe, and then specifically Trustee Green, thank you for your service in the BOR over the last 3 years on behalf of the LACERA team, and obviously your chairship this year. So thank you again.
Thank you.
Mr. Grable and I are holding annual stakeholder engagement meetings. We want to be proactive in terms of our outreach. You'll see that there's a list that's not an all-inclusive list. I think one of the things we want to be intentional about is our ability to engage our stakeholders, whether it's our labor partners, our employee groups, and some of the things we want to make sure we address. And it's always nice to be able to meet with these individuals face-to-face is the fund health, as Mr. Grable talked about, especially with respect to the fiduciary net position chart that he highlighted, but also our benefit and member education and just how we're going about our strategy to engage members and ensure that they understand both their benefit and health offerings to them. So we'll have those meetings over the course of the next year. We met with SEIU earlier this month or a couple of months ago and had a good meeting with David Green, and we look forward to meeting with others. We look forward to those meetings in the next year. Culture survey, we talked about this a couple of months ago. We had a culture survey that was issued to all of our staff a few months ago. We're now in the analysis phase. We are actively conducting focus groups with our team members. Those started this week, and our goal is to formulate an action plan collectively of all staff to focus on some culture initiatives moving forward. With that, there is going to be presentations at the ACRE committee as well as the BOR on just the raw results of the culture surveys. So those would be the ACRE committee November 20th. There'll be a presentation, and then the BOR meeting in December. So I wanted to alert the trustees to that. And then lastly, just want to announce we're in the retirement business. As JJ highlighted, one of our internal retirees, we also want to highlight an upcoming retirement. Our assistant executive officer, Laura Guglielmo, will be retiring in March of 2026. Certainly want to wish her well in her retirement and thank her for certainly giving us lead time, but appreciate the contributions over the last, I think it's been over 4 years now. So this is not a 4 to 7 year IPO exit. This is a legitimate planning. I'm sure Laura diligently planned her retirement. So again, want to congratulate Laura on her retirement and look forward to celebrating her retirement over the next 3 to 4 months. So with that, Chair Green, stand for any questions.
Smee, do you have a question? Please go ahead.
A couple minor questions. If you go to slide 6, it's something really minor. So I just want to look at the funding ratio there for the fiscal year ending June 2025. Is that number updated or the same number carried from last year? 80.9% funding ratio, top left corner.
Yeah, so that's for the most recent actuarial valuation, which is June, I think 30th, 2024. Is that the, I don't know if that's the updated. It's 24, yeah. So it's not the most
Not
recent.
updated yet.
Yeah.
Okay, I'm looking forward to see the updated number because I expect it to go up a little bit, right?
Yeah, and this, it's important to note, trustee me, this is an annual chart, so we update this as the actual evaluations are, those are audited, and then once we have the final numbers, then we'll update the data on this chart.
Got it, thank you. Slide 10. Thank you. So I'm looking at this vacancy rate here. I have a little bit concern about systems. It looks like it's standing out to me, you know, what the number of vacancy in system division. I don't know how big the division, how many people there, that I cannot calculate the vacancy rate there. I was wondering if it's substantial higher than the organization vacancy rate. Is that vacancy rate impacting that division function that potentially, you know, put risk to our operation?
No, I appreciate the comment, trustee me. So most of those vacancies are backfilled with temporary staff, so there isn't a significant gap in terms of personnel. We are working through filling those permanently. In terms of the actual vacancy rate, absent those temporary staff. I think it aligns with the organization rate, maybe a little bit higher, but I can provide that offline to you, that particular vacancy rate for this systems division specifically. But a lot of those systems vacancies are filled right now with temporary staff, and we're working through the permanent staffing.
I know
through
that
the
we cannot
recruitment.
work on every vacant position all at once, right, for all divisions. So I feel like it might need to be a balance, right? Look out for the division that may be impacted more. Just finding the balance of work on what is needed to avoid, impact to our operation. Just a thought.
Yeah, definitely. And just for the education of the board, all divisions have HR liaisons that work on their critical vacancies. So we do take a balanced approach on addressing critical needs across all 15 divisions. And it's just a matter of pace. And certainly that's something we're working
Thank you.
to correct.
That's what I have, Chair.
Thank you. Anybody else? Thank you. Moving on. From Ms. Rivas, item 7A, please.
Good morning, Chair and trustees. I'll let the slides get up on the screen. All right. So I'm Jess Rivas, Staff Counsel, and I'm here to provide a very brief but important update on Form 700 filing on a new change in state law that will be impacting a good number of our filers, including the members of this board. Next slide. So by way of background, as you know, the Form 700 Statement of Economic Interests is the way that public officials disclose their financial interests. It's an important tool for filers to identify their actual and potential conflicts of interest, and these are public documents. We must produce them if they're requested by a member of the public. Our current process here at LACERA, all LACERA filers file with LACERA. No one files with the county or the FPPC, with one exception. The TTC, the Treasurer and Tax Collector, does file with the FPC, but everyone else is filing directly with LACERA right now. And we've been using an e-filing system for 3 years now. And our practice, we are not required to post forms online, but again, if anyone were to request them, we would have to provide them. Next slide. So two recent laws came into effect, or actually the first one came into effect last year, and that required many public officials who previously filed with their own agency to start filing with the FPPC starting in January of this year, 2025. We worked with FPPC and confirmed that that did not affect us. However, a new state law just was signed by the governor in October and will go into effect in January. And that does affect us. And that will require all public officials who manage public investments to begin filing with the FPPC electronically starting in January. Next slide. So who are these filers? These are set out in our conflict of interest codes. Conflict of interest code, you can see the list there. It includes the members of this board, CEO, CIO, chief counsel, our PIOs, and then all of our outside independent contractors, consultants, and any of their employees who manage public investments pursuant to a contract with LACERA. And as you can imagine, that is a good number of our filers. It's over 100 LACERA filers out of our 250 current filers. Next slide. So beginning in January 2026, these filers will be filing with the FPPC's e-filing system. Luckily, they use the same system as we do, so it won't be too difficult or too strange to transition. It'll be very familiar to you. It's look exactly the same. It'll just be with the FPPC, not LACERA. Filers will, unfortunately, though, have to re-enter their information about their investments from scratch. The data from our system won't transfer over to their system, but prospectively, they will stay in their system. And so in future years, you won't have to re-enter your info every year. All the notices will be coming from the FPPC. They'll review the forms for completeness, conduct an audit, issue fines, etc. They'll be handling everything. They will post the forms online, though. I did confirm that. I asked them directly. And the legal office, however, we will continue to remain a resource for you. If you have any questions about the filing requirements, we will assist with tracking down late forms, making sure you're able to get onto the system and complete your form in a timely manner. And we will also receive a copy of all of your forms, all of the filers' forms, so that our records are complete and we can do conflicts checks as necessary. And then finally, the last point, just want to make sure you're aware, our conflict of interest code currently sets out what filers manage public investments, but the county, which is our code reviewing body, is going to make a minor adjustment to our code to comply with the new state law, and it will just designate that those filers will be filing with the FPPC now. So that's going to be happening over the next coming months. And with that, I'm happy to answer any questions.
Go ahead, Ms. Fee.
Thank you, Chair. Thank you for the presentation. Appreciate you keeping up with what's the new law regulation out and make sure we're complying. So glad to see that we're also going to have a copy to check the conflict interest internally, not solely rely on the outside organization do it for us, right? So I'm glad to hear that. So for the compliance, we want to make sure we're compliant. So I have a question about on slide 4, that how, if we go to slide 4, just confirmation, how we come to determination, the position identifier. The principal investment office, right? I look at the list, looks like only up to principal investment office that need to report. My understanding is that everyone in the team manage, investment. So
Sure,
how do we come to this determination and making sure we comply with what's
So this list is based on FPPC regulations that set out who is required to, or rather who manages public investments. And they specifically call out the level of the chief investment officer and the principal investment officers as managing public investments. The folks that fall beneath those are expressly left out of that definition. However, we require them to file through our own code. They're code filers. So basically, the regulations call out those positions as requiring to file, but our own code designates those positions as filing. So they still file, but they just don't fall into this list, this category.
I'm glad. So it's called out by the policy here, not us defining the principal investment office.
Right.
And also really believe to hear that we have our internal form that we're still going to file. Yeah.
Yes, so they'll continue filing with LACERA though. That's the only difference. They won't file with FPPC.
It's good to know.
Yeah.
Thank you so much.
Sure,
And thank you for presentation. Back to you, Chair.
Thank you. Anybody else? That's interesting, I mean, I'm first term, but yeah, it was through the county, then it was through LACERA, and now it's through the government.
A lot of changes. So I'm here to be a resource and help smooth the transition. So
you guys are great. I just need a copy of my old one because nothing's really changed. So.
Yeah.
Anyway, thank you so much for that presentation.
Thank you.
Moving forward, does anybody have any, the rest of these are informational only. Does anybody have any questions for item 7B through 7G? We can move forward from that. They're all information only. All right, excellent. Items for staff review, item number 8.
I don't have anything, just Ms. Mee had requested some information regarding the vacancies for the system staff that we'll send to her.
Yeah. Good to go. Staff can handle that. Items for future agenda, item 9.
Nothing.
Good to the order. Call the roll.
Mr. Rue? Mr. Gatto?
I have nothing, thank you.
Ms. Mee?
I'll say a couple quick words. Like yesterday was Veterans Days. I just want to shout out to all the veterans out there. Wish them happy holiday, and including the people that, even though they're not recognized veteran, but may sacrifice to the country to fight and protect this nation. We can only hope, right, for all the veterans and other people still in the service that risking their life, to protect this country. We can only hope this country, this nation can go to a better place. So that's it. That's all I want to say. And thank you for today's discussion.
Thank you, Ms. Gisbert. Mr. Jones?
No.
Ms. Jack?
A couple of months ago, we launched our Financial Analyst 1 fellowship program. And the goal is, it's a 2-year rotational program. The goal is to hire 2 fellows each year. And really excited about introducing the second fellow, FA1 fellow for LACERA, who's with us today, Albert Zhang. Albert joined us last week, I believe. Albert has a fantastic background, certainly much smarter than me, with 2 degrees from 2 UCs, with a undergraduate in Earth System Science, and a graduate degree from UCLA in quantitative economics and econometrics. I even have a hard time saying it, So I think that we're certainly going to take advantage of those skills in terms of being very additive to the quantitative side, in really building out the work that we do in the investment division. I appreciate 2 things in Albert's background. One is while in college, he was a teaching assistant. I think that it says a lot about someone that can, I had a hard enough time just getting through class, someone who can get through class plus, contribute to their peers. I think that says a tremendous amount. And also, I think that a great profession, first job out of college, working for Ernst & Young. I think that accounting is, I guess this is me making 2 statements today outside my lane, is I think accounting is a great background for anything that is financially related, because you learn everything about financial statements. And Albert began his career at Ernst & Young. And once again, really excited to have Albert join the team.
Thank you. Thanks for that. Yeah, and welcome aboard. Yeah, a couple things. As per policy, reporting on travel, I spent a week in at Super Investor, Super Return. I guess they're lumping the 2 titles together now. I already mentioned the AI. Some of the segments, comparatively to the last event I went to a couple years ago, I felt that the keynotes and some of the topics covered weren't as robust, and maybe it was the newness of it. It's like when you eat something and it's really good, but you're hungry, but and not to bash it, I think there's a lot to take away. That the private equity, it's primarily focused on private equity, but some of the topics were the AI, which I already discussed. Private equity in the EU versus the US, that was an interesting, that was the first segment. Grace MC that, and the panel consisted of, primarily European folks, and but with one American, and just, the emphasis on the US market and private equity, how it's still very large, and the reluctance in some areas. And I noted this from the last Super Investor, and the Swiss are very reluctant to get involved with that, that kind of stuff. It's quite interesting to hear each kind of panel speaker talk about the role in private equity, and geographically, and how they invest domestically. It was and still the U.S. market has the lion's share of most of the private equity, and that one of the terms they used was oh gosh, I forgot. I should have wrote it. I have it written down in my notes, but it's basically like sticking with your home team, so to speak. Go with what you know, which I thought was an interesting concept. That you kind of centralize your funds and where you're comfortable, your home base. And so, it was a really good discussion. Not much in the way of Q&A, but the other thing that was interesting was the military spending, private equity stuff. That was kind of fascinating, with our support of other things going on. I mean, obviously the military industrial complex makes money, and kind of the restock of weapons as we send out our old stock, and that creation of income from that. It truly, it is, it's fascinating. So, so that's the report. It was a good trip. I have the one regret, which is, public transportation, abroad is, after sitting in 2.5 hours of traffic today, I had some very intense road rage because, I could have hopped on a train and been here at 7. Morning, Linda. And on Veterans Day, happy belated Veterans Day to all the veterans. And it also was the Marine Corps' birthday yesterday. So happy belated birthday to the Marines. And with that, I will say, go Army, beat Navy. Hooah. All right, and that's all I got. Say again. Let's take a quick, say again. We'll take a quick break. Let's come back at 10:40. Take a quick break and we'll get into executive session. Thank you. Thank you, Alex. Just as a point of order, we're going to go back into open session. We have a physical quorum. It's going to be item 4, approval of the minutes from October 8th. I have a motion to approve.
So moved.
Mr. Gatto made the motion, Mr. Jones seconded, Ms. Ginsburg? Yes. Ms. Me?
Yes.
Mr. Green?
Aye.
Mr. Rue?
Yes.
Mr. Gatto?
Aye.
Ms. Martinez?
Yes.
Mr. Jones?
Yes.
Okay, the motion passes unanimously.
Excellent. And there's no other items that need to be addressed with the quorum, correct?
Recording stopped.
Thank you. Can we just